Well, good morning, everyone. My name is Robin Dolezal. With me, as always, is Alex Pars and David Renzi. Together, we are with Ironwood Financial. Welcome to today's episode of our podcast. Today, we're going to be discussing inflation. Inflation obviously has been at the core of everyone's thinking for the last 18 months, and so this is going to be a great topic for today. Good morning, gentlemen. How are you?
Good. How are you?
Good.
Doing well.
Great to see you guys. Thanks for joining me again on another podcast episode. Obviously, we're going to be talking about inflation as we discussed. It seems like it's getting in control, but it's definitely been a topic of discussion with many of our meetings over the last, year and a half.
Yep. So, Robin, you're absolutely right. It's something that we've been seeing for years and years, has had some impact on our clients, but now it's more of a problem than ever. So even in the low inflationary times that we've had for the last decade or 15 years, I can share a story. We have a client who's either so concerned about the political environment or the economy or something like that, so they're never really ready to pull the trigger and take their money out of their savings account. So they've had money in their savings account for, call it 15 years, and they've been living off that. Well, as you all know, savings accounts haven't been keeping up with inflation, and they're not hardly earning anything. So what was a solid retirement when they retired is now on very shaky ground, and it looks like they're going to run out of money because you can't expect to keep up with inflation with savings. So we need to look at and talk about other investments, other ways of financial planning that make sure that you do keep up with inflation, because as we always talk about, a retiree's number one fear is running out of money, and that's what's probably going to happen to this couple.
Right.
Yeah, I think to speak to Alex's point there are some strategies that you can use in terms of the financial planning side and to make sure that you're not overly aggressive with your assumption. And one of the things that we do is we'll basically run Social Security for less than we run inflation. As you've seen this year, the COLA adjustment is less than the headline inflation number, so that's a pretty good indication that at some point your Social Security will lose purchasing power.
People complain about that every year. Why is it that inflation is 5% and Social Security only went up by 3%? Or last year when inflation was 15% and they got 9%. So it does seem like that's a pretty common, a common theme that goes on throughout the years.
Well, let's talk about, what does typically inflation run? We're at 2.5% typically?
That's an interesting question. Historically, I think the average is about 2.8, 2.9. But that takes into account some big extremes. So from the period between the Great Recession and the pandemic, inflation was basically non-existent. And you didn't notice it, it wasn't a worry. In fact, inflation was your friend. So if you're the average American, you've got, a house, 2 kids, and a dog, and you're working your job, your mortgage payment isn't going up, okay? Because it's locked in. But meanwhile, you're getting your inflationary raises every year, little raises. So inflation, wasn't a big deal to you. Okay. Now that's very different for retirees because as we talked about, you're not getting those raises anymore. Okay. Social Security doesn't tend to keep up. And then also you don't get promotions. You don't get, hey, inflation was 5, so you get 7. That's what you used to get when you're in the workforce, but not anymore.
Yeah, I think one of the most important things that someone can do is basically lock in fixed living expenses or fixed costs. So your mortgage, maybe hold your car for a little longer, but once your mortgage is locked in, you have a pretty good idea of what your biggest expense, or most people's biggest expense, will be throughout their retirement years. I've seen many cases this year where we have clients that maybe rent a summertime apartment or do some kind of temporary living situation and don't have a big mortgage or don't have the mortgage locked in, and they're pretty amazed at what the increase in inflation of what landlords are charging nowadays.
Yeah, I saw last year a lot of markets were doing a 40% increase in rent, and that's hard to budget for when you're in retirement.
Yeah, that's a far cry from 2.9% increase.
Yeah.
And you mentioned it. Obviously, for retirees, one of the things they can do is prioritizing paying down all their high interest debt. Obviously, the mortgage is something that people always ask us. Most people feel like they should pay that off. And at some cases it doesn't necessarily make sense because they've got such a great low interest rate. But if you do have other debt or even a mortgage that's got a high interest debt, those are the things you should really concentrate on paying down before you actually pull the trigger and retiring. Adjustable rates are also something that people should consider as well, especially with high inflationary times.
Yeah, so we should talk about what is inflation and also what's driving all this inflation as well. Because when we're planning for the future, we need to be able to understand, what's causing this. right? Because if we plan for 15% inflation every year, that's going to make for a really weird plan if it turns out that inflation's really 3. So the primary measure of inflation is the CPI or the PCE, which is supposedly the one that the Fed likes to watch. And they're saying they want to get back to 2% inflation, which we had prior to the pandemic, and we had for a good decade or so. Back in the 70s, it was much higher, and people still remember that. They remember their 17% mortgages and their payments going through the roof because of that really high inflation. So that is a worry a lot of people share in today's environment, which is it looks a little, or it did look at least a little eerily similar to that hyperinflationary era. The difference though this time is the Fed's got a much better handle on monetary policy. So they've really stomped this out by raising interest rates very quickly and starting to pull money out of the economy. The reason it was so high was because they pumped too much money in during the pandemic. The initial round of aid was needed. When you shut down the economy, you need to keep businesses afloat. You need to get people staying in their houses, so let's pump some money in. But then once the economy really took off and opened up again, they kept giving out money. And then after things were record profits, they kept giving out money. And surprisingly, that turned into inflation, or unsurprisingly.
Well, and it didn't slow us down from spending money either during the pandemic. We may have shifted our spending, but we were all still at home, and I was, did this as well. I jumped on Amazon or whatever online shopping services and continued to spend money. So the consumer was very healthily spending money while the feds and Washington were also pumping money into the system.
Yeah. So we've got this inflation that the Fed's been fighting, and it looks like they're almost done with their fights. So to project the last couple of years of inflation going forward is probably not realistic. But you do need to put an inflationary rate into your projections. I know a lot of times when we run a financial plan, we'll say, okay, we're going to look out to when you're 90. How much money do you have left? Okay, and if the answer is, oh my gosh, look, I've got $5 million, the first thing I do is come back to living expenses. Say, hey, look, today you said you were spending $75,000, and just the impact of inflation on that $75,000 has turned it into $150. So that $5 million is really only 2.5. So it is a big impact when you're looking at those long periods of time, because people don't retire and die 5 years later, hopefully. Typically they retire and they live another 20, 30, maybe even 40 years, and inflation has a big impact the more time you give it.
So what's interesting, you just made me realize a conversation we've had with a few clients about inflation and the effects it has on retirees when they spend their money. And we can use a hamburger, for example. They're used to spending, 50 cents on a burger, for example. Clients used to spending $3 on a burger, and now it's $20 a burger. But there's a mindset, right? We've talked about this with some clients. They may have the money, they may be fighting inflation, but that emotional, tie to not needing to spend that kind of money, or just saying, I'm not spending that on that kind of thing. It's just, it does affect how a retiree spends their money.
Yeah, absolutely. And you see that with housing, and you see that with cars. I remember when pickup trucks were 20 grand. And now when you pull up pickup trucks, they're 100. And it's like, it's hard to wrap your mind around spending $100,000 on a pickup truck.
Alex and I just had a meeting, what was last week, about a client wanted to buy a car. I forget what she came in at, saying, yeah, I think I'm going to need $20,000 for a car. And we were like, yeah, that's not going to happen. I think all cars are kind of starting at the $40,000 range. So
yeah, I think they're in closer to 60 when you look at the average. So
yeah.
But yes, absolutely, that does affect people's spending habits as they age. And that's something we haven't seen a lot of in the low inflationary times. And now we're seeing a lot of it in this high inflationary time, where we had a couple of years where prices jumped 20, 25, 30%. People are shifting away from, I'm not going to do that. It just doesn't sit right with me.
Right. So,
and I think one of the things that's important, as Alex alluded to earlier, is setting up your portfolio in a manner that can potentially help you keep pace with inflation. So as Alex mentioned, we had a client, he kept his stuff in fixed rate assets and savings accounts and low paying bonds, and it's really eroded his purchasing power. Now, that's one of the reasons that when you retire, you have to have some risky assets involved. You do have that 30-year time span, hopefully. And so that's where you could potentially make a good argument for including some stocks or some floating rate products into your portfolio. And the benefit of having stocks is that just like the working population, they have the ability to adjust their costs and prices that they charge to reflect the current inflation rate. so they can adjust things instantly. And if the market is willing to pay for that, then great. Your stock price should go up as their profits go up. If they're not, then things will drop. But inflation itself can be kind of a self-fulfilling prophecy, in that if everyone is expecting inflation, then everyone expects prices to go up, and they'll act in that manner, and it could drive prices up. So you may need to reevaluate your current investment strategy and think of including things that you may have not before.
Well, and as you said, it doesn't need to be a super aggressive investment philosophy either. I mean, the other side is that bonds are now actually paying something, whereas 18 months ago, they may have been paying 2.5%. Now we're getting 7 and 8%. So, your investment strategy doesn't necessarily need to be quote unquote risky. It just does need to involve other asset classes aside from cash.
Yeah, and that's actually something we've seen a lot of in the last year, which is the banks have been slow to keep up with rising inflation and interest rates. So lots of people have been saying, hey, I got extra money in the bank. What do I do with it? And it's like, well, if you don't know what you want to do with it, we can put it into something that's very short term, earning 5-6%. And then you can decide what you want to do with it, whether it's for long-term investing or whether it's for short term. So there's no reason, I had one lady very concerned about where the economy was going, and she was worried about her business, and she had done very well. She'd saved up $500,000 and she had it in her savings account, which was earning nothing. And so I said, okay, well, why don't we just put into this 3-month investment that's earning 5%? Okay. And she said, well, let me think about it. I was like, okay, every month that you think about it, you lose $2,000 in interest. Okay. It's practically a no-brainer right now that you should not have money in your checking account or savings account if it's not earning at least 4%. So if it's earning 4% or more, fine. But there are options now that we're not out there, and the banks are not really taking advantage of it. They're taking advantage of their clients mostly.
So Alex, you had actually started talking about this with the Fed and what the Fed was doing to try and reduce inflation. Can we talk about, because there might be some people who still don't understand why or how what the Fed is doing is actually reducing inflation. So can you walk us through a little bit about how that's working?
So going back to the root of the problem was we had too much demand. So you give an American $1, what do? They spend $2. Right? So
you're saying 4% average savings rate isn't enough?
Yeah, that's probably that. I just read this morning that all the savings from the pandemic are gone. So yes, so we gave out too much money, and that created a demand spike. So you give an American a check for, let's call it $5,000, $10,000. What do they do with that? They go buy a new car, down payment on something, and they finance the rest. But bottom line is they spend it. And that took everything off the shelves. You couldn't buy anything. You couldn't buy cars. You couldn't buy houses. You couldn't buy yachts. You name it, sold out. And it's funny. You'd think
I had to stop buying my yachts, Alex.
That's right. I mean, remember when they had
I know the supply chain delays were really a bummer.
I mean, but it's not just in everyday items. It went all the way up the chain because they gave out so much money. So even your $10 million items were sold out. So this demand spike created a bunch of inflation, and now the Fed has to get rid of it. So how do they do that? Well, by reducing demand. So we had 2.5-3% mortgages. And so I like using housing as an example because people understand it. So if you've got a $200,000 house and you're paying 3%, your mortgage is, $1,200, right? Well, what happens, fast forward 2 years, prices have gone up because of all this demand, and, rates are still 3%. Now that house is worth $400,000, okay? Well, your payment hasn't changed. Good for you. But if you're looking to move, now the Fed raises interest rates. Okay, so the Fed goes out, they raise interest rates. They're currently around 8% on that same home. Well, if you wanted to move to a $500,000 home, you might be paying $4,000 a month. Okay, well, you're in a $400,000 home paying $1,200. Are you going to make that move? Chances are you can't afford it, or you just don't see the value in it, so you don't make the move. Well, when you don't make the move, who doesn't get paid? The realtor doesn't get paid, the mortgage broker doesn't get paid, the movers don't get paid, the painters don't get paid, the appliance people, the furniture people, the gardeners. Everything you do when you move to a new house, none of those people get paid. What that means is we've just, destroyed a lot of demand. So that's how you slow down the economy, is all those people suddenly have less work. When they have less work, they spend less, and everything they buy from, or every person or service they use, also has less money. So that's the theory behind why raising interest rates, makes payments higher, makes people buy less and therefore slows down inflation and slows down demand.
So I know we got to a peak of what, 9.5% of inflation, and we're down now to about 4%, right?
Yeah, that's about right. Depending on which measure you look at, and depending on what's going on, with oil prices, et cetera. So to combat inflation, you need to have investments that are likely to outpace inflation. And a good thing to do is to run a projection. A lot of people, they run projections on their retirement without including inflation. Okay, so a lot of the tools that we use and we have that we run with our clients, they allow you to fiddle with the inflation rate. They run simulations based on different rates of return. So you can really say, all right, what if I don't take any risk? What happens to my retirement? What if I take lots of risk? What happens to my retirement? What if there's too much inflation, not enough? And it really helps you narrow down how you should be investing, as opposed to saying, hey, I can afford to be super conservative because I've got so much money, or I need to be more aggressive because I need to keep up with inflation.
I guess that is an important point as well. Running projections with different market conditions is very important to realizing, hey, am I being too aggressive or too conservative? Because oftentimes what we'll see is people find those calculators online where they enter their expenses and then they do inflation at 3% every year, and then they'll enter their investment portfolio and they'll just pick a number like 6% every year. And everyone knows that the market, or the stock market, or asset markets in general, are very volatile. So you're not going to get that 6% every year. You could get 2% one year, negative 20 one year, and 15 the next. So it's very important to run projections and do stuff like Monte Carlo simulations where you're adding volatility to see where you actually lie instead of just doing the simple compounding.
Well, it's also important that, we've seen this in the past where we see these projections from folks who have maybe talked to an advisor or planner of some sort, and we've seen these projections where they're assuming a 12% rate of return every single year. So it's, yes, run their inflation at 3%, but let's be a little bit more conservative with our projections as far as rates of return as well.
I mean, I don't know, that Bernie guy did really well. He got about 15 every year.
All right. Well, thank you guys. I appreciate it. I think we talked a lot about some great ideas in regards to inflation and how to combat that and how to make sure that, people who are retiring know how to invest their portfolio and keep up with inflation in regards to their expenses as well. Obviously, folks, if you're listening to this and you're not a client, you still have questions, we're here as a resource. You can find us at ironwoodfinancial.com or 520-318-4600. We're here to help. We're here to be a resource.
Happy to answer questions. We get lots of financial questions on all sorts of topics, inflation, et cetera. There's not much we haven't run across in the last 20 years or so.
Yeah, there's lots of folks coming in right now who are worried about inflation or wondering if they can retire. So we'd be happy to help you figure that out for you as well. Folks, if you've got other questions that you want us to address in a future podcast, please let us know. You can email us or find us on ironwoodfinancial.com. If you've got a great topic, we will definitely address that.
Thanks for watching.